Hey, good morning, everybody. Hope you're doing well on this Saturday. First, let me start. So the software I use to do these webinars, it's really good. I love it. It takes care, automates a lot of stuff. It's probably one of the better ones out there for webinars. But yeah, I had some issues with it just recently. Excuse me, got some caught in my throat there. So it looks like I'm probably every 6 months or so going to have everybody re-enroll to do it. If I was doing this every single week, I don't have to do that. But the way their structure is set up, their software is written, doing it twice a month, it creates some issues that they found. So yeah, I apologize for having to get people to re-enroll, and it's probably something we'll have to do every 6 months or so unless they change their programming. Okay, but that said, today I'm going to jump into, a little bit. Obviously, I think the biggest thing is inflation that came out this week, and that caught all the news. Everybody's been talking about that. But I want to kind of talk about how I see inflation right now, and where I think I see everything going in the markets. When those numbers came out, of course, there a few people asked me about them. So I always try to do these presentations based on questions from clients. I know that if I get 2 or 3 questions from you as clients, that it probably means there's more people have the same question. So inflation is clearly something that's been plaguing everyone. But then I'm going to talk about a little bit how inflation kind of sort of leads to a deflation, also known as recession. The cure for higher prices is always higher prices. At some point people pull back, and that leads to lower prices. I want to talk about some other things. Dollar strength. The dollar is something we talked about this a couple months ago. I said it is critical to watch the dollar because it tells you so much about the world economy. We'll talk about that, some other recessionary signs, and then what moves am I making right now in your portfolios. So I want to do a really quick recap of sort of my investment thesis for longer and short term. So the longer term, I've been saying, I think we have a period where inflation is going to be the key driver for investments. And when I say longer term, I'm talking, 10 or 15 years. I've shown you slides in the past that show just the cycles between commodities and stocks. And they really do have kind of a negative correlation. When commodities are in a bull market, typically stocks are struggling, and vice versa. And you have these patterns, if you go back and you look at, really from 2000 to 2009, when we had the tech bubble burst all the way to the financial crisis, that was a good period for commodities, bad period for stocks. But then since 2009 on, commodities up until recently have struggled, whereas stocks have done very well. You just have these natural cycles. Everything in life is cyclical. So I think we're at a point where we're starting to see that commodities and inflation is going to be probably the bigger trade here for the longer term, 10, 15 years. Why would I say that? One, it's been underdevelopment of our commodity infrastructure. Everything from mining to oil to all that stuff, they have not been putting as much money into that complex for a couple of reasons. One, the past 10 years previous to 2020, commodities weren't doing well. Stocks were doing well. So there wasn't as much of a need for companies to invest in the infrastructure because they weren't getting as much money out of it. That's the biggest thing. They weren't, if oil is only $40 a barrel, companies are a little less apt to put a lot of money into the infrastructure and research and development when the payout's only $40. Now, at $100 a barrel, maybe it makes more sense. The second reason is sort of, government policies around the world, specifically, the ESG, all this ESG stuff, supposedly to save the world from global warming. I'm not a big believer in that. I think there's ulterior motives to the government doing this stuff. Gives them a lot more control. But trying to move to, and I'm not against trying to move to clean energies, but making these moves at the expense of our traditional energies and mining and everything like that is going to have a price to pay. I always say, they want wind and solar. They want it. But it's kind of like, let's say it is the future. Let's say it's going to be the Michael Jordan of the NBA someday, right? It will be the key. But right now, Michael Jordan is a 2-year-old infant. It's just not ready to go. And if they don't understand that at the governmental level, then inflation is going to be a constant, because we have just so much demand still for oil and coal and all other kinds of energy sources that if they're not putting money into the infrastructure, there's going to be less and less of it, which less supply, same demand, price goes up. The other big reason I think inflation is going to be a bigger term trend here is we really don't have globalization as a tailwind anymore. What we had before was, really from the 90s through the 2000s and even the 2010s, it was still, we were seeing prices drop, because we were outsourcing to China and other third world countries. Well, we're starting to see those issues with those. Part of it is geopolitical. So there could be some issues on that end. They may stop shipping as much to us just to harm our economy. But the other thing too is eventually, at first, China and some of these third world countries had enormous capacity, tons of workforce, just an enormous amount of things that they could produce based on their capacity. But that capacity, as more and more manufacturing and items go to them, that capacity shrinks. They don't have as much. So as their capacity shrinks, it means pretty much they're going to start paying higher wages. They're going to start to see that they have some supply and demand issues, and that's going to eventually be passed along to us. So I think those are some trends that make me think the next 10, 15 years are going to be sort of inflationary. Now, that's longer term. Shorter term here is this inflation is going to actually start to cause deflation. Like I said, higher prices are the cure for higher prices. It does have an effect as more and more people have to pay so much more for goods and services. They're going to cut back on goods and services. The other thing is I've been talking about all along is the Fed wants to bring down inflation. We are in an election year and they're getting an enormous amount of pressure to stem inflation because that right now is the number one issue for voters is inflation. And that's not surprising. So the Fed in the past, and anytime the stock market's pulled back 10% or more, the Fed would step in and throw tons of liquidity just to prop up the stock market. So now the stock investors have kind of gotten used to, they've got their Pavlovian response to when the market drops a little bit and they just expect the Fed's going to step in at some point. I don't think it's going to happen here until inflation is clearly in the rear view mirror, at least in the short term. Until they can bang their chest and say, we solved the inflation issue, they're not going to back off. So that is not good for investment markets. And I think they're going to let the stock market struggle, even if that means an even much bigger drawdown than we've had now, just to get inflation in check. So if you go, I'm sure you don't follow all the financial people like I do, but they all still expect the Fed to step in here really soon and backtrack. I don't think it's going to happen. I don't think it's going to happen unless unemployment starts to rear its head. I mean, right now they've got that backdrop to full employment. Remember, the Fed's two mandates: stable prices, full employment. Full employment's, we've got it right now. They're working on the stable prices. So long as full employment stays in check and we don't have any kind of credit crisis, something that causes like a Lehman moment, a bank going under, something along those lines, I think the Fed's going to inflict some pain. I just do. And what I've been saying along, I fully expect recession if we're not already in it. And where do you want to be in recession? There's really 4 asset classes that you want to be: cash, long-dated treasuries, vehicles that short the market, and gold for the most part. Okay, so that's the thesis. Let's jump into inflation. So I think everybody pretty much knows that they heard the inflation rate was hotter than expected, came in at 9.1% year over year for June. Okay, so really high. Haven't seen inflation like this, going all the way back to the early 80s. So this chart basically goes back to 92. You can see we're really on the upper edge of this right now. And the thing is, there's a financial shop that I follow. They do some really good research. They actually say the real CPI, the real inflation rate, is about 12.9%. And the reason they say that is the headline CPI uses something called owner's equivalent rent. So that's how they measure the cost of housing. But the owner equivalent rent component is a very slow moving component. It doesn't really track as quickly what rents are doing or what home prices are doing. So what they do is they use something called the Case-Shiller index, which tracks the real estate in most of the metropolitan markets, big metro markets. So it's a little bit quicker. It's more timely. And they're saying based on that, based on the rents, based on what's happening with home prices, really it's about 12.9% is what we're seeing. And the bad news is a lot of the inflation that we're seeing right now is on staples. So, we're talking utilities, gasoline, food, and electricity. They're actually accelerating faster than what's been going on with some other sectors of what makes up the CPI. And we know why that's bad. I've used this stat a million times so far. 40% of Americans don't have $1,000 in their bank account. I know that's surprising. If you're watching this, more than likely you've probably been investing for years, and you can't imagine only having $700 to your name. But that's the case, 40% of Americans. So this inflation, especially consumer staples, is absolutely ravishing these folks. And I've shown graphs in the past that credit card debt is going up substantially, savings rates coming down. So a lot of folks are hoping this comes down. They're using debt to basically fund a basic lifestyle: food on the table, gas in the car, heat in the house, or air conditioning. They're putting on debt, hoping that they can just ride through it for a little bit. But if it doesn't happen, at some point, these folks are going to hit the wall. This chart gives you a quick breakdown just from May to June, what different parts of the CPI, what they did. So you can kind of see energy, motor fuel went way up. So the way to read this chart is the big circle in it is June and the little circle is May. So if you see motor fuel, you see a little circle at the bottom, and then essentially a 8% jump from May to June in motor fuel. Energy was big. Some things went down. You can kind of see that lodging in airfares, so that's good. They actually went down, but for the most part, food was up about 1% month to month. Medical was up 0.7, clothing 0.8, new vehicles 0.7, used vehicles 1.6. That's just from 1 month. These are all the inputs that go into the CPI, that 9.1%. What is a little alarming, obviously the staples were going up much faster than other sectors, but this is a pretty broad-based inflation. I mean, everything's for the most part going up. Yeah, we got a little bit of relief on some travel stuff, but for the most part, broad-based inflationary expectations. And the thing is, I think in the very, very short term, maybe July's number, maybe even August, the inflation is going to continue to stay up where it is. Now, I'll talk about this in a second, but obviously some things have pulled back. But right now, the producer price inputs. So these are the companies that essentially make the products that we consume, the US PPI. They're at 11.3 last month. Okay, so it's even higher than the 9.1 consumer price index. And when these folks are experiencing this kind of inflation, what are they going to do? They could either let their profit margin shrink, or they pass it along to the consumers. And I think it's going to be somewhere in between, a little bit of both. But what that tells me is when you see that the producer inflation rate, the PPI, is sort of a precursor to our inflation rate, because a lot of what we consume first has to go through the producers. So in the very, very short term, I don't think we're going to see that much of a decrease in inflation. And then on top of it, if that's not a swift kick to the backside, what we have is really wages are falling relative to inflation. So real hourly earnings fell 3.5% last month. So you've got a situation, at least up to this point, where prices are going up, particularly in staples, and people's wages aren't buying as much. They're falling relative to what costs are doing. Not a good situation. The cure to higher prices is higher prices. Okay. So we'll talk about the inflation, but I think, like I said, eventually inflation is going to lead to deflation. Higher prices are a cure for higher prices. One of the things we're already starting to see that kind of alarms me a little bit here, the dollar. We talked about, we got to watch the dollar. The dollar is breaking out of a longer term trend. It's breaking through a ceiling it's had in place here since 2017. And we're not at the peak where we were during the tech bubble burst, but it is starting to really make an impact. And normally the dollar is going to be fantastic to reduce inflation. If you think about it for a second, if your dollar is getting stronger, that means you can purchase more goods and services. Usually the dollar getting stronger also means foreign currencies are weakening. So it makes it cheaper to buy their goods and services, makes it cheaper to travel there. So it's helping us. But what should be alarming to people is the dollar has been strengthening for a while, and we've still been seeing inflation here. Could you imagine what inflation would be if the dollar was dropping? So this is an issue. Right now, the euro is at parity with the dollar, so it's at pretty much 1-to-1. So if you're planning a trip to Europe, great time to do it. Great time to do it, because if you go over there, you're essentially going to have prices that are similar to here. A 6-pack of beer is going to be $6 here. It's going to be $6 there. Whereas for most of, really going all the way back to the early 2000s was the last time we had parity with the euro. So pretty much from 2002 up until just recently, if you went to Europe, you're going to pay a little bit more for your beer. That $6 six pack here might cost you $7 over there. So, but this kind of tells you, why was the dollar so strong in 2000? And if you also look here, it's strengthened in 2008. Remember, we are the world reserve currency. The world functions on the dollar. We are 24% of the world's economic output, or GDP. But yet 87% of all transactions are using dollars. So when the dollar really strengthens relative to other currencies, what it means is there's a little bit of a panic going on. People are craving the dollar. It's usually not a good sign when the dollar is strengthening across the board. If it's one currency, yeah, you might be able to look at that country and see there's an issue going on. But when it's across the board, it's not good. So the euro's at par, and who knows? I mean, it could be at 80 cents here by the end of the summer. The Canadian Loonie has been dropping like a rock. And this is despite the fact that the Canadian central bank has been raising rates much faster than our central bank. So they are trying to strengthen the Loonie, but yet it still continues to lose value relative to the dollar. Japanese yen is a total mess as well. So the yen is losing value relative to the dollar very fast. In fact, we're right back to where it was early 2000s, even past that, almost to the 90s. So, we're seeing they're having a lot of issues. When the dollar's getting this strong, there's something underneath that's a problem. And I think the first place we'll see some of this problem is emerging market debt. So emerging markets, again, these are countries, it's China, it's South America, it's India, it's Eastern Europe. Since the world works on the dollar as the reserve currency, most of these countries have to take out debt, and they do it in dollars. They can't do it in their local currency. They have to do it in dollars. So their governments, our government has debt denominated or dollar denominated debt, but so does theirs, the US dollar. So if their currency starts to lose value relative to the US dollar, that means it's costing them more to service their debt. So they're really starting to see some serious issues in the emerging markets. It hasn't broken yet, but it's getting awfully close. This one gives you saying basically a fifth of emerging market bond issuers are in distressed territory right now. So 20%. Now, if the dollar continues to strengthen, this number will continue to go up, and we'll probably see something break. This is what could happen when the Fed could reverse course, something along those lines. If you have a default in a South American country or Eastern European country or something like that. The other reason that, the dollar is getting stronger, and also that there's something under the water here, you don't know what it is, but there's something there, is the Federal Reserve's reverse repo balance sheet. I'm not going to get into what reverse repo is. But basically it's a way for banks to get money off their balance sheet and put it in a safe spot. So think of reverse repo as the ultimate safe spot, safe haven. And it basically means that banks and other financial institutions are afraid of their counterparty risk. They're afraid of other parties not being able to pay. The other parties could be individual consumers, it could be businesses, it could be foreign governments. They're afraid they're not going to be able to make their payments. So what they're doing, these financial institutions are putting their money with the Fed. And this number has absolutely skyrocketed to over $2 trillion. So there's some serious fear there. This also creates demand for the dollar, which is why the dollar is going up. The dollar going up is not a good thing for corporate profits. So this is a chart here. The blue line shows earnings for the S&P 500. And then the gold line is the dollar, but it's inverted. So you see at the very far right, the dollar is going, it looks like it's going down, but in reality, it means the dollar is going up. It's inverted. So pretty strong correlation between a weak dollar and good earnings, a strong dollar and bad earnings. So you can kind of see this is a really good correlation. So with the dollar going up like it is right now, typically is not going to be very good for S&P 500 earnings. Okay, so I said inflation, obviously it's been brutal. And with the PPI, so the producer price index, we might see another month or so of inflation because they'll pass that along to us. But we're already starting to see higher prices being the cure for higher prices. This gives you an idea. Commodities have started to pull back. And I've been saying that longer term, I think commodities here in the next 10, 15 years, great place to be. But if we have a recession, commodities are going to get bludgeoned just as stocks will get bludgeoned. This gives you an idea just kind of what's happened here since the start of the year, roughly. And you can start to see industrial metals have already really had a sizable pullback. Agriculture, also sizable pullback, and now also crude oil. Crude hasn't had as much of a pullback as some of the other commodities, but it's already starting to come in. Now, the funny thing is, well, maybe not funny, but we could see the recession really start to bloom and see commodities spike back up, at least on the oil and agriculture, all because of the Russia-Ukraine issue. Russia is saying that this month they're going to really start to pull back the gas to Germany, and that's going to have a huge impact on the cost of oil. So you could see oil spike back up just because of geopolitical issues. And it's also agriculture too. So I think everybody knows Ukraine is not only a huge agricultural support, but also on the fertilizer side of it, which those markets have been disrupted. And we're not going to know the true effect of that until, the late summer, early fall, when the typical harvest season takes place. So at that point, we'll really start to see if there's going to be a shortage of agricultural products and what that's going to do to prices. So we could be in a weird situation. Usually a recession, commodities come way down, but because of geopolitical issues, we could actually see parts of the commodity complex go up, agriculture and oil, because of what's going on there. My next session that I'm going to do in a couple of weeks, I'm going to do a deep dive into energy, and we'll talk more about that. And basically give you an overview of energy, talk about, is it possible to be more green, and then also just look a little bit more into what's happening to Germany specifically, along with Sri Lanka. Both of those are issues that Sri Lanka is a perfect issue, talking about emerging markets having problems. And we'll get into that. It's part of an energy thing. It's part of a dollar thing. There's a lot of issues going on, but those things could spread to a lot of other countries. But yeah, commodities change year over year. It's starting to drop substantially. So, I mean, that's good for the inflation rate. But I think what is really telling you is more of an endemic. There's an issue here with the economy overall. And in fact, so far, the oil drop has actually been pretty unprecedented, relative to other downturns. The circles they have here, they've got the two, they got the Delta and Omicron, when oil had a big drop off, but even the recent sell-off is actually bigger than what COVID did to the price of oil. So I mean, it's good at the pump. It's good in the short term, but is it just part of prices coming down, or is there something worse happening here? This also shows real quick the week following July 4th, dating back to 2010, the demand for gasoline. It usually drops somewhat, as you can imagine. Summer travel season slows a little bit, but it's been very sizable this year relative to previous years. So is that people can't afford it and we're heading to recession? Is it just that the commodities have pulled back? What's going on here? Now the dollar strength, I've already said dollar strong is good for inflation because you can buy more goods and services with your dollar. So if that's the case, clearly dollar strength is going to be bad for commodities. That's part of it. So again, what you have here is, it's hard to see the blue line, which represents the dollar. That is inverted again. And then the price of commodities is the white line. It is not inverted. But you can basically kind of see the correlation there between the strong dollar and sinking commodities. It hasn't happened too much. That blue line's dropping quite a bit, meaning the dollar's gone up a lot, and commodities really only started to pull back. So you go back to, is the dollar getting stronger for a good reason or a bad reason? If it's a recessionary reason, and that's kind of what it looks like, everyone's starting to panic, it's going to be bad for commodities, but it also kind of would be bad for the economy. And in fact, the markets are basically showing recession. Bonds and stocks, you can already see bonds sort of peaked July of last year. Stocks peaked the beginning of this year. And now we're starting to see in the yellow line commodities peaking. So all of these asset classes now are starting to head towards showing some recessionary features. This would be awesome to put housing on here as well. I did housing the last presentation. Housing is, in fact, the asset class that's the last lagging indicator. So as commodities struggle right now, I think we're also going to start to see housing struggle. You start to see a little bit, but it's the last asset class usually to fall. So housing's going to be the last one we see. So as soon as the housing's really starting to drop, then we'll know we're probably through the mess that we're in. We have an inverted yield curve talking about recessions. This is pretty much a telltale sign for, every recession we've ever had, the yield curve has inverted. Now the yield curve has inverted, and we haven't had recession a couple times, but for the most part, there's a very strong correlation. Probably 90% of the time when the yield curve inverts, recession happens. So this shows you the 2-year and 10-year Treasury. It's now, you can actually get 0.15% more buying a 2-year Treasury bond as opposed to buying a 10-year Treasury bond. Now, it's not supposed to work that way, right? A normal yield curve slopes upward. If you're going to loan money to me for 1 year, you may not demand as much of an interest rate as opposed to 10 years because there's less risk I'm going to default in 1 year as opposed to 10 years. So you should get a higher yield from me if you loan it to me for 10 years or longer. What the market's saying right now is you're getting paid more on the short term than you are for the longer term. It's kind of crazy. I'll show you a chart here in a second why that is. But a couple other things that are starting to sort of scream recession. Inventory compared to new orders versus the consumer price index. Consumer price index is in blue and it's inverted. Okay, so again, think the opposite. So when the blue line's going down, that actually means inflation is going up and vice versa. And then usually that white line follows exactly what's happening with inflation. So So basically, kind of what we're going to expect here is we're going to see inflation come down, and orders and everything like that will go down. And one of the big reasons is inventories are really high right now. If you followed the markets at all, you might have a month ago heard Target and Walmart both say that they had extremely high inventories. They were worried about the supply chain, so they just ordered tons and tons of stuff, assuming that the consumer's back after COVID, but they're finding out because of inflation, consumers not back, consumers struggling. So they're stuck with a lot of these inventories, which they're going to now mark down, which should hopefully bring inflation down. But that's clearly not a good sign for for the economy overall. So I just wanted to start to jump in and give you some perspective on this. Right now, the stock decline so far has been awfully painful. Nobody's liked it. But I've been saying that I think we're in the early innings of it. We haven't even really erased more than a year of previous gains. In a typical bear market, you see 3 to 5 years of gains evaporated. If you're talking 08 or even 2000, you see 10 years or more of gains evaporated. And this chart gives you an idea of where we stand relative to previous downturns. And you can kind of see that, no matter what market downturn we're looking at here, we still got a ways to go. So I hate these past few sessions have all been so negative, but I'm just trying to present what I see as sort of the realism. And then, of course, this year has been difficult because bonds are also down. So you have the stock market down and you have bonds down, which typically don't happen. They're usually a teeter-totter, seesaw, but it hasn't happened so far this year. So a typical 60-40 portfolio is down roughly 16% so far this year. Whereas in previous years, it doesn't look quite as bad because the bonds provided some protection. Okay, so I talked a second ago, we got an inverted yield curve. So you can buy the 2-year at get a higher interest rate on a 2-year bond right now than a 10-year. Well, why would that be? What's going on there? Well, long-dated bonds are basically saying that they think the Fed's going to pivot. So when you look at the short term, 2 years or less, maybe even 5 years or less, it's looking at very current numbers like inflation rates and things like that. So if your inflation rate's 9%, usually you want to get 9% on any bond that you're going to get just to hold your value. But, right now you can get 3.2% on a 2-year treasury. So people in the short term see this inflation, they need to get as much yield as they can. So they're demanding that the shorter term part of the yield curve is going to match inflation. It's not really matching inflation, but it's better than longer dated. The longer dated bonds, when you get out 10 years or more, they're actually looking out a long ways. They're not looking at the current CPI figures. They're looking out. And what they're saying right now is they think the Fed's going to backtrack and start cutting. In fact, right now, the federal funds are projected to be less in June 2024 than they were in December 2022 by 1%. So the market's already saying like it's pricing in a recession, and they're pricing in that the Fed is going to start to backtrack really quickly. Like I said, I don't think it's going to happen until we really see recession come down substantially, till we see prices really across the board get to the point where it's more manageable for people. And the thing is, manageable for people, gasoline's come down 30, 40 cents a gallon. You think, oh, that's good. And it is good. But we're still well over $4 a gallon. So until it gets back to like $2.50 a gallon, it's really not a manageable figure for most people. So there's a lot that they need to pull out of here, not just slow inflation, but they need to start to bring prices down. I think they're going to be focused on that. The markets and the financial people think the Fed's going to pivot. So that's why right now longer dated bonds are actually yielding a little bit less than short term, because it's thinking down the road, and they're basically saying all this talk by the Fed about raising rates is all bunk. They don't believe it. Or if they do it, they're going to have to reverse course awfully quickly. So I've talked about this in the past. 4 asset classes do well: cash, things that short the market, gold, and long dated treasuries. But I just showed you a graph that bonds are down this year. So long dated treasuries have been not a good place to be this year. They're down substantially. I started buying into long dated bonds 3 or 4 weeks ago, because at some point, bonds are going to get back to that natural seesaw, teeter-totter relationship with stocks for a couple of reasons. One, if the stock markets really start to come down, it's going to leave the stock market and go to things that are safe. And no matter what you think of treasuries, you know you're going to be repaid on it. You know, you're getting a decent interest rate now. You're at 3%, which is well above the dividend rate of the stock market. So money will run to that. But the other thing is, like I've been saying, is at some point when rates get so high, that the cure to higher prices is higher prices. So when rates get so high that borrowing stops or slows substantially, then rates will pull back down to find that happy medium to pick up on lending. So what I'm looking at here, you know, this goes back to essentially just before COVID, and it peaked at COVID at 179. The TLT is the 20-year Treasury iShare 20-year Treasury ETF. Peaked at 179. You can see what it's done since then. It hit 108 just recently. So really this year, I mean, it's down 30%. But I think it's going to be a great place to be if we really do enter into recession. So I'm watching that 108 figure. I want to see some sort of test of it. I think it's at 114 right now. So if it pulls back to 109, 110, something like that, and then starts to lift, we know we've retested the lows and things look good. And I'm probably going to put some of our shorter term bonds, which we have a lot of, move it into longer dated bonds, because I think if we go into recession, TLT could get easily back to, you know, the next level, that line there at 139. I think we could easily get back to that. That would just really mean rates are at like 2.2%. And then if it goes even more, you know, 155 is the next stopping point or ceiling or resistance. So I think I think bonds are going to start to become that safe haven, at least treasuries, real soon. And the other reason I think treasuries are going to do well is because we've seen from these slides today, demand for the dollar is going up. And one of the key dollar instruments in the world are treasuries. So what moves am I making right now? Well, we've done very well with commodities, but they have finally broken through the 200-day moving average. So, you know, my system is basically showing that it's time to sell them. I do again think over the next 10 years, commodities will provide outperformance relative to stocks. And we may get back in if the Russia-Ukraine issue causes things to spike back up, or we may be more with a scalpel next time. I think agriculture is probably going to see a good jump up later this year because of the Ukraine-Russia thing. But for right now, sell the commodities and go to some short-term cash bonds, treasuries, things like that. Same with gold. Gold is one of the assets that, one of the 4 I always talk about. It is a safe haven. Gold's down about 6% this year. So, I mean, relative to the market being down 24, bonds being down 15, it is a safe haven. You're losing less money with it. And I do think when it really starts to get hectic, when we start to see volatility pop, gold's going to do extremely well. I'm a huge gold fan. Gold miners are rock bottom cheap. I've talked about that a few months ago. But right now, the technicals are telling me let's go to the sidelines and see what happens. We may be back in gold real fast. I kind of think we're going to see a pop, but at least right now it's broken that 200-day. Another holding that we've got, we made a move early in the year, which it did really well. We moved to consumer staples. So as we were selling our stock positions, getting out of the broad-based stock holdings, I went into energy, I went into staples, I went into utilities. Staples, again, are just, it's toothpaste, it's toilet paper, it's stuff you need every single day. But they've been struggling now too. And that happens in recessions. Oil, utilities, staples are a late bull market sector to be in. But when the recession comes, these things also struggle. So staples have kind of broken through the 200-day moving average. So now it's going to be, we're probably going to liquidate and just see, kind of see what happens. And I've already mentioned energy. So here's the good thing. I've talked about this. I've been selling on strength for a while. So I think I'm 90% out of oil. We've been selling. We sold a lot in May. We sold a lot in June. So we only have a little bit left, but I'm going to get rid of what we have remaining. Same with the staples. I've been selling staples on strength. When it was getting to really high levels, I think we were 50% out of staples. We basically are 80% out of utilities, just because as the strength kept going up, I just kept selling little bits, rather than trying to time the tops or anything like that, or I was selling in the strength. So it did well for us because things have pulled back. So thinking that we're heading to recession has worked. The last one is our master limited partnerships, which is an oil play. These are the pipelines, shipping companies, things like that do the oil infrastructure. So they just move oil from point A to point B. I love these things because it's, 8.5% dividend yield. I'm selling into the strength in May and June. We sold about half, but we still have half, but I'm now going to liquidate the remaining parts and just wait and see what happens. Just thinking that if this is recession signs, then the stock market's going to continue to have some real struggles. And we've been adding, if you're a client of mine, you see two ticker symbols, VIXM and TAIL, tail, VIXM and tail. Both of those invest in asset classes that essentially go against the market. So tail invests in put options. Put options, you use those when you think the market's going down. You use call options if you're bullish, put options if you're bearish. So it invests in put options. And then VIXM invests in the VIX, the volatility index. And the volatility index, this is one of the reasons why I've been saying that I don't think we're through the bear market yet, because volatility has not gotten that high yet. It has not broken past 35. Usually in a good bear market, you get to 45 or more. Right now, I think it's at 26 or 25. So the market has been awfully calm despite the fact that it's pulled back 25%. Usually you don't have capitulation. You don't have the end of the bear market until you see that VIX figure up to screaming high levels. And that's where this VIXM will provide us some good protection. It is up for the year, I think 6%. But if we get the volatility up to 80, it'll provide some really, really good protection. Okay. Always like to finish with the lawyer saying hello. Obviously, if you're not a client of mine, please don't trade based on this. Get some advice. I try to make sure that all the information I provide is complete and accurate, but of course, can't guarantee that, blah, blah, blah. You can read this if you need to. And again, I'm trying to hype this up. This is my blog, podcast, video site, Saving Yourself from Wall Street, trying to put a lot more content out there. So, rather than just getting some stuff, every other Saturday, and then I send out a monthly newsletter. If you want more educational stuff, if you just can't get enough of me, this is a good place to go. You'll get lots of information. You can sign up for a newsletter there, but you also can see all of our past information as well. Okay. So that's basically kind of where we're at right now. Some of the moves I'll be making. Really love to get your questions just so that I know kind of how to prepare these things. Like I said, when I get questions from 2 or 3 clients, I pretty much know that there's a lot more clients that have that same question, and I try to elaborate a little bit on it. So we'll have the next session, the beginning of August. So it's a little bit of a break. So I'm going to be putting out some more material here in the near term, just on different topics, some interview topics, things like that. But yeah, if you have any questions, please let me know. And I hope you have a great weekend, because I don't see any questions actually right now. Let me check one last time.